today's piece, we look at forming suitable expectations for what sort of returns we're going to get for the markets over the very long term. And in so doing, we find that much of the industry, including some leading investment management organizations, engage in the most dangerous, not to mention ubiquitous, shortcut in financial planning. And what is that? That's using historical returns to predict the future. The returns you got from the past are unlikely to resemble the ones that you get in the future. What happens when you get a long period of above average returns? You're going to have below average yields. And since yields are the primary driver of future returns, we should expect lower returns moving forward. And so while much of the industry will point you down the path of using historical returns to predict the future, we at Research Affiliates know this relationship and want you to embed this relationship in better financial planning for your clients. So how do we do that? Let's turn to the Asset Allocation Interactive site at Research Affiliates. The Asset Allocation Interactive site breaks down the components of return for virtually any financial asset into your yield plus the growth rate plus or minus any changes to valuation. Let's apply that very simple framework to U.S. equities. Now, when we look at the yield for U.S. equities, we find that U.S. equities give today about a 2% yield. How much have equities grown their earnings and dividends over time? It's about 1.5%. In one way of producing future expected returns, which is our yield plus growth, we simply add those two together. And what does that give us? It gives us about a 3.3% expected return for U.S. equities. Many people correctly assert that U.S. equities are trading at very high valuations. And when we look at the Shiller PE over time, we indeed find that that's true. We only find 2 or 3 instances relative to the long-term history where stocks are trading at levels above where they are today. A prudent fiduciary would say, well, gosh, if stocks are trading at a really high valuation level, maybe I should assume some degree of mean reversion back to more normal levels. And so in our second way of forecasting returns, which is what we call valuation dependent, we assume stocks don't trade all the way back to their historical norms. We just assume halfway. We can again refer to the same table we talked about before. And what do we find? We find that equities give us that same 2% dividend yield, that same 1.3% growth rate in earnings and dividends after inflation, but we lose nearly 3% per year because of changing valuations. So that leaves us with a return of about 0.5%. And we find some assets are likely to give us higher returns than historical norms. Some are, like U.S. equities, are likely going to disappoint. That allows you, the financial advisors, to have more honest engagement with clients for what sort of returns are going to be. And in the end, we think that's a real source of value add that financial advisors can bring to the table.